There could be companies in the same economy reporting their segment results based on different bases. So it could be varied results. There could be various inconsistencies among their segment reportings. Obviously, their financial statements are prepared on a framework, which is IFRS. So they would be consistent, but their segment reporting information could be inconsistent or lack comparability. Their interpretational issues open to the judgment of management. There are many issues, we'll discuss that, which are open to the judgment of the management. So if company A decides to report this matter, they could only limit their disclosure to that matter, whereas company B could decide on some other matters. There are practical issues in Pakistan context, how performance is measured, difference in perceptions, cash flows versus book profits versus book profits plus some other profits. So we know in various entities there are various perceptions, and the way they look at their segments could be very different. Some companies, some traditional companies, some privately managed companies, they have cash flow as their, if you are generating cash flows, you are a good segment. Lack of reliable MIS, that's a problem which we foresee in Pakistan, that reliable MIS could be a major hindrance in this IFRS. And because the IFRS has to, you must follow the management reports, they must be reliable, and you must apply some other test to ensure they're reliable. MIS parameters could be different. It is possible that the management, which is the MIS which the management is using, is not disclosable to the auditors. That is also possible. So the management parameters, the MIS parameters have to be the ones which are obviously, which should be reported. Obviously, they have, the information has to be made public, the segments information would go in public. Why is it important today? January 1st, 2009 is the date. This standard must be followed for the years beginning January 1st, 2009. Why it is important for us? Because this standard has been adopted by ICAP and SECP, and the half-yearly results for the companies falling in June 2009 would have to comply with this standard. Is this only about convergence with US GAAP? To me, probably yes. But yes, there is some more meaningful information for users, consistency with the management reports, and less time and cost of obtaining the information. Core principle: an entity shall disclose information to enable users of its financial statements to evaluate the nature and financial effects of the business activities in which it engages and the economic environments in which it operates. So that is the core principle. And it will be explained in this slide. Now this is a memo written by ISB, IFRS 8 staff, to the public company. Useful information to users. Please provide Mr. John Q. Public with useful information that will help him get a grip of what your main activities are, where are they located, and how well they do. Yours sincerely. And the postscript is, this should be very much based on the information used by management to accomplish the same goal. Now, obviously, there is a good intention into following this model, which is reflected here. That the outside users, they should also look at the segment results from the same angle as the management looks. Okay, so the intention is very good, and the memo elaborates that the users do not want information based on some technical jargons, and they are distorted by some technical accounting treatments. They want the results to be made to be made public as they are seen by the management themselves. So That is the logic behind this model. But as I said, there are many problems attached to that. So the key features are segments through the eyes of management and financial information management users. There are 4 simple stages. Identify the CODM. Now there is a concept of chief operating decision maker, which has to be identified. And who is that is subjective. We'll know how we need to identify that. This could be one person, this could be a group of persons. The second step is identify the operating segments. The third one is determine the reportable segments. So the reportable segments could be an aggregation of few operating segments. So the operating segments, if you are reporting all the operating segments, they all become reporting segments. But if you're aggregating a couple of segments, then reportable segments become less in number. And the fourth one, present the required information and reconcile to primary statements. Obviously, the numbers which you are giving in the segment information must be reconciled to the bottom line of your P&L. The revenues and there are different items to be reconciled. Okay, this chief operating decision maker who can allocate resources, who would allocate resources, assesses performance. It has to be a function, not a title. So in the hierarchy, when you move upwards, you need to see who is the person or the function which allocates resources to various segments. Like if a segment comes that I need these many $1 million of investments, so who takes that decision that this segment is profitable, we should allocate resources, or we should not allocate resources? Then who assesses the performance? Which one is making more profits and not? And then it has to be, it can be a function. It can be board of directors, it can be CEO, it can be COO. So to finding a CODM, we have 3 excerpts here, three committee meetings. HR committee approved compensation terms for Mr. Hussain, newly hired controller, on April 1st, 2008. Investment committee recommended additional investment for ongoing research projects in July. And then executive committee reviewed 5-year forecast for Sri Lanka operations, approved closure of 2 manufacturing plants in Africa. This happened in June 2008. Now, which one do you think is CODM? The first one, the second one, or the third one? The executive committee is the CODM here. Okay, identify the operating segments. What are the key factors of an operating segment? It must engage in business activities. So if there are no business activities, for example, there are cost centers which are not directly involved in business activities, they can't become segment. Operating results are regularly reviewed by CODM to assess performance and make decisions. So there must be a regular review of their results also by the CODM. And discrete financial information has to be available. If this information is not available, and as we just discussed that this standard very much heavily relies on the MIS itself, so there can't be any reporting done. A component that has all the following features: engages in business activities. So it could have startup activities, it could have R&D operations of its own, it could have vertically integrated business, and then functional departments. It is possible when there is a transfer pricing mechanism available. One department is charging revenues to another department, so there can be a segment that function can become a segment also. Operating segment component that has all the following features. Now, Its operating results are regularly reviewed by CODM to assess performance and make decisions. Several sets of financial information. Use the one which is most consistent with financial. Now, the problem can arise when there are several sets. MIS, like management, reviews results of segments from various angles. So there can be more than one set of financial information. So we must use the one which is most consistent with financial statements. And then this is another issue in matrix operations. Matrix reporting, I'm sure you must be familiar with the organogram whereby there is a CEO or COO largely responsible for the segments under that company, but all the different business heads have direct reporting abroad, and their direct reportings are to somebody else sitting in some geographic location. So obviously in this matrix reporting type of environment, you don't know how to identify, because the CEO, if you consider him as to be CODM, then what about the decisions which are taken directly by people sitting abroad? So there are gray areas here in matrix reporting, but what the guidance is that in this kind of situation, use products and services to identify segment. Now, whatever products and services are clubbed, and for example, you have a consumer business. In consumer business, you have toothpaste business, you have other business, you have food business, you have ice cream business. So you go by products and services. You don't go by their matrix style, because if you try to follow matrix style, what would happen is that if your, for example, ice cream business head is reporting to somebody sitting in Dubai, and this becomes a part of our Pakistan segment is part of Dubai segment, whereas your consumer business or other food business is being reported to somebody sitting in Singapore, and it becomes Pakistan segment of that food segment becomes part of the Singapore entity. So the matrix reporting can give you divergent results. So you can't follow really those for segment reporting. You can't follow the geographic basis. If that could be followed, the results could be very different. So in that case, you just go by the products and determine your segments based on the product line. An operating segment would regularly have a segment manager who is directly accountable to and maintains regular contact with the CODM. So normally we see the business managers or the like food business is being run by one person, he's the manager. So that is an indication that that is a separate segment and we should follow that. So discrete information available, it must be reliable, that is verifiable. If there is information which is not verifiable, obviously there is problem in reporting that. Consistent with CODM approach to operate business. The information must be consistent. This is very essential. If it is not, then the whole essence and logic is defeated. This IFRS wants the users to look at the business from the same eyes as the management or the CODM is looking at. So if it is not consistent, the CODM approach is different from what you are reporting in segments, so the purpose is defeated. Used by CODM, obviously the information must also be used by CODM. So if these conditions are met, then yes, that information can be relied upon and can be used as segment information. Determine the reportable segments. Identify each operating segment that exceeds 10% threshold. We remember that in the old IS also. The revenues, when they exceed 10% of the total revenues, revenues of one segment, so that becomes a segment. Aggregate any operating segment that meet all aggregation criteria. There is an aggregation criteria if there are similar characteristics, similar processes, similar products, then can be aggregated. So if that is aggregated, then you aggregate it. For the remaining operating segments below 10% threshold, aggregate with each other if majority of aggregation criteria met. So the aggregation is optional. You can aggregate or you may not like to aggregate. If reportable segments are less than 75% of revenue, add more reportable segments. So the criteria is that 75% of revenues should be split into segments at least. If it is less than 75%, then you try to find out more segments. Aggregation criteria. Aggregation is consistent with core principle. Segments have similar economic characteristics. Segments similar on each of 5 specified criteria. We will discuss that. When aggregating 2 immaterial segments, only a majority of the 5 specified criteria need to be. What are the 5 criteria? Nature of product services, nature of production process, type or class of customer, method of distribution, nature of regulatory environment. For example, if the regulator is different, like SBP is a regulator for few segments, then you aggregate all of them into one. And SECP is a different, so you aggregate. So it can go by regulatory environment. It can go by method of distribution. If there is a particular distribution chain and that takes care of more than one product or more than one segment, so you can aggregate those segments. Then again, type or class of customer, nature of production process, and the first one is very obvious. Maximum limit of reportable segments is 10. Although I've mentioned maximum, the standard does not explicitly say 10, but it says that when it reaches to 10, it may become very impractical to handle it, so you might decide to stop it there. So up to 10 is okay. Present the required information and reconcile to primary statements. Disclosure of certain minimal information. Must disclose measure of assets, but there is a change here, measure of profit. This was a non-GAAP measure, reconciliation of totals to primary financial statements. So at the moment, I'll just bring the whole slide first. Okay. This is a must disclosure. This disclosure is made only when the information is available. The IFRS, which is issued last year, included measure of assets, like segment-wise assets must be disclosed. But there is an improvement in 2009 which has deleted it from here, and it has gone there. So now the latest position is that only the measure of profit must be disclosed. It is a must for each segment separately. And then there has to be a reconciliation for primary financial statements. So these are the must. These are optional, but these are required if the information is available. Segment assets, segment liabilities, this is essential. It was initially considered to be essential, but later on, it was initially here, but later on it also got transferred here. Significant items like depreciation, interest, revenue, associates, and capex. So in each segment, what is the capital expenditure during the year? It is also a preferred disclosure, but not a must. Disclosure of certain minimal must disclose general information, factors used to identify segments, which of 5 bases used. So the disclosure must say that what were the factors used to identify those segments. Types of products and services of each segment, measurement basis for intra-segment transactions, transfer pricing, nature of difference. This is nature of difference means the reconciliation, profit and loss, assets, liabilities, changes in policies from last year. So reconciliation would include all these. Nature and effect of any asymmetrical allocations to segments. What it means is that it is possible that an asset is not distributed to a segment. It is held by another segment, but the depreciation charge is allocated to that segment. So it is asymmetrical. It is not in line, like ideally the asset should be also part of that segment balance sheet. But if it is different, the nature and the effect must be disclosed. Entity-wide disclosures. Like this previous slide was the disclosures for the segments. Now the entity-wide. Applies to all entities subject to standard. All entities which have their results published, they're listed entities, they must follow this standard. We all know that. So they all would follow this entity-wide disclosure even if they don't have a segment. So even if a company has one line of business and that is one segment, even then these disclosures are required. Information about product services, geographical areas, domicile and foreign revenues, domicile and foreign non-current assets, major customers. The above is not required if given at segment level. Major customer does not mean the names of the customers, but major customers aggregation as to the company's major customers. Top 10, for example, constitute this much of the revenues. Retrospective application in all the following: when adopted, when segment is initially identified as reportable, changes in organization structure. Like in 1 year, in year 1, company decides that these are the segments. In year 2, they might change it. They might decide that no, there is another segment. So they give some other information. So whatever is the decision, the information, the change should be retrospective, so that the comparative information is also available. So if there are 5 segments in year 1 and they become 6 segments in year 2, so the year 2 financial statement would include comparative information for 6 segments. And there can be changes in organization structure which could trigger the. So this is the recap. First we go from here to upwards, identify the segments, then determine the reportable segments. As I said, there could be a difference, there could be aggregation of operating segments to make it to reportable, and then present the information and reconcile. Other considerations, issues: verifiability of information, documentation and analysis and conclusion. The management or the CODM, when they decide which one should be the segment, on what basis, what were the factors, the information which is available, it all should be verifiable. Consistency of conclusions and information. This is very important aspect, consistency, because you can't apply different factors to determine different segments. Like you can apply products and services to determine, what you cannot do is to determine some segments based on product and services and some segments based on geographic location. That is illogical. So all the segments must follow a consistent basis. If it is product and services, then all should follow that. If it is geography, then all should follow that. If it is some other basis, as there are 5 factors, so they all must follow that. Segment reporting used basis inconsistent with IFRS. As I said in the beginning, it is possible that the management is using in their own IMS some accounting treatment which is not consistent with IFRS. For example, LIFO method for inventories. They could use that for their own management reporting purposes. To be more prudent, they want LIFO method to be followed. So there can be inconsistencies from the IFRS in the segment information. Employee benefit plan accounting, for example, could be different. They may not allocate the charge to the segments and they just determine it on a total basis. That is okay, that would come in the reconciliation, but they can also use full liability method or some other methods for segments. And then transfer pricing, is it market based or not? So these are the issues. How this will affect? Consequential amendment 236, reallocation of goodwill. This is important because what will happen is that the goodwill will have to be reallocated to operating segment level, and there could be a potential impairment. So the goodwill which we decided to test for, we are talking about impairment testing. We decided to test for impairment for goodwill at component level, at a CGU level. And then we thought there is some impairment based on this analysis. Now this segment information is what it requires is that we assess goodwill impairment on the operating segment level as well. So if it is possible that there is some impairment here, first we assess it here, there is an impairment, we book that, then we go down here. If there is further impairment, we book that as well. Management reporting may require substantial improvement. Documentation of analysis and conclusions required to make information reliable. Inconsistencies in bases within segments be removed, and previous segment reporting may no longer be acceptable. So these are the challenges, and we must start looking at these areas where there are inconsistent treatments. We should ask management to remove them. Where there are no MIS, we should definitely ask them to start having reliable MIS. And if there are other issues which we foresee, we should highlight that, bring to the table and resolve that upfront. Potentially more segments may affect goodwill allocation and impairment. We just discussed that. Regulators expect consistency, obviously, but as I said, that there would be inconsistent segment information from various competitors in the industry. Education of investors may be required. I'm sure there must be various questions from investors and stockholders that how come the segment information is on different bases giving different results, whereas the P&L is giving different results. So there has to be an education process for that. Can be different from competitors. So two companies running in a competitive environment can have different types of segment reporting which may not be comparable at all. Things we see from here are different from things we see from there, and that was the whole idea behind IFRS 8. There is a handout in here, handout 6, which probably will not be able to run through, but it summarizes the whole IFRS. You can refer to it at a later stage. Okay, so now we are done with the two major standards, IFRS 3 and IFRS 8. If there are any questions relating to IFRS 8, we can handle it now, and then we can start on the rest of the amendments and IFRICs. There's still quite a lot to go, so I would try to be as quick as possible. Yes.
You're asking the user to use two eyes, the IFRS eyes and then IFRS eye and the management eye. And then you need to educate the user also. To my mind, it will create chaos and confusion. It will confuse the user more than, giving any meaningful information because of the inconsistency within the competitors and using two different eyes. So why have this in the first place, this segment reporting?
Well, it is a requirement, so all the companies should follow it. But
can we debate on the utility at all?
Well, we can debate it for the sake of debate at this forum, probably not the right forum, but at the regulator and at the institute level can be debated definitely. Segment information is useful in the sense because if when you go to companies, for example, multinationals, I mean, it's not that much relevant in a local environment. But if you look at any big multinational, they have segments, and they all segments have, over the period of time, like let's say in the last 20 years or so, they have become very independent, having direct reporting lines back to the head office or to the region office. So at times, we also wonder as to the IFRS information is that, very, they're least bothered about IFRS-based information at times. What they focus on is their own segment report results, their reporting. It should be based on their management MIS, and that's it. They're not really bothered. So if the management's focus is at that end, then what the hell are we doing? So that gives you some idea as to the importance of segment information, why it is important. If the whole resource allocation is going into, those bases, if the profitability is measured on some basis which is not reflected in the P&L, the P&L is a one total P&L of various, just IFRS 3 is an example. IFRS 3 business combination. You have a food business, you have a tea business, you have a ice cream business. These are all different businesses. These are all different entities. You just merge them. So look at them from the business angle.
Yeah, but the reconciliation will again confuse the reader. Even the qualified accountant will be confused. What to talk of the normal investor?
Definitely. Initially it would happen, but gradually it would improve, must improve.
We don't have, I don't think we don't have that learned constituency in our country.
Okay, so if there are any other questions, people from Pricewaterhouse would recall there was a template OM1, OM2. So people can, we can share that also. In our methodology, we look at the management reports, and then there is a template which is a reconciliation actually from the numbers in management report to the numbers reflected in the P&L, and we call that OM1, OM2. So that is something which is already in pipeline, being followed by Big Four internationally, and we were also using it because of the same reason. So this segment information is not really a weird thing. It has been, in the US it is being followed for many years, and that's why the auditors are also trained to see through the same way. So I'm sure in the beginning it would be some difficult, but later on people should digest it. Okay, shall we move on? So we roughly would take it would take another 45 minutes, I think. So by 9 we should be able to close it. There was an amendment in IFRS 1 and IS 27 regarding the cost of investment. This amendment was not really relevant in Pakistan context because it was only for the companies or the economies which were not following IFRS, and there was first time adoption of IFRS 1. So IFRS 1, because we already were following, so it was not relevant in our case. The background of this this amendment was that once you start following IFRS, when you, let's say in January 2009, you start following it, and you had investments which were valued at fair value, but under IFRS, if you start following associate accounting, under IS 28, if that falls under IS 28, you follow associate accounting, and that allows you to go back to the cost model. So if you want to follow the cost model, how would you determine the cost? You go back and you do the 10 years working or 20 years working. That's impractical. So what they allowed was that as at the date of transaction, whatever the fair value, it is deemed cost, and you carry it from there. Next one is hedging of portions of financial instruments. This was I-39 amendment. The amendment prohibits designating inflation as a hedgeable component of a fixed rate debt. Why it prohibits? Because inflation cannot be a risk which should be hedged. If you are running a business or whatever in an economy, inflation is an unavoidable risk. It should never be hedged. So there was a doubt that it is possible to hedge an inflation risk also. So that doubt is removed, that no, it is not possible. In a hedge of one-sided risk with options, it prohibits including time value in the hedge risk. Now again, in the one-sided risk hedging, although it is not preferred, but there are, it is allowed that options can be used as hedging instruments to hedge one side, upside or downside of one financial asset or a liability. So that is called one-sided risk management. In that case, because time value is something which does not really, the management does not really manage any risk through time value. You see, the time value is something which ticks off, the clock ticks off. So it is not relevant to hedge time value of an option. So what you cannot do is to hedge time value of an option under the amendment, which is anyway, it's not going to any impact in Pakistan. Putable financial instruments and obligations arising on liquidation. The amendment applies to certain financial instruments, capital back from the issuing entity for cash or another financial asset. So if it is at the investor's option and automatically on the occurrence of a specified event and on liquidation of a limited life entity, or when liquidation is at the option of the investor. The background is that if you remember under IS-32, there were very stringent regulations laid down some in 2004, that even if you give somebody an equity instrument, but the investor has an option to put it back and get the cash back, that becomes a liability. That is not an equity. So there were some of the mutual funds equities were to be classified as a liability instead of equity. Now here is an exception. It says that there could be some putable instruments, like I have a share in a company which I can put it back and get the sale proceeds from the majority shareholder or whoever. So it should be logically liability under IS-32. But if these conditions are met, it would be considered as equity. It would be, if it is at investor's option, automatically on occurrence of a specified event, and in case of liquidation, the investor would get the proceeds. So the amendment applies to certain financial instruments issued by the entity that give the investor the right to get its capital back from the issuing entity for cash or another financial asset. To be classified as equity, such instruments must meet the strict criteria set out in the amendment. For example, one requirement is that the instrument holder is entitled to a pro rata share of net assets on liquidation, which could be indicative of an equity-like return. A putable minority interest that is classified as equity in the subsidiary is always treated as a liability. Effective from periods January 2009 should be applied retrospectively. I'm sure there would be some putable transactions in Pakistan, but not many. Share-based payments, vesting conditions and cancellations. There is an amendment. The amendment narrows the definition of vesting conditions only to service and performance conditions. Previous definition implied that, if you recall IFRS 2, it says that there are service and performance conditions. There are vesting conditions which could include service and performance conditions. So if an employee is working in a time zone, let's say, if it reaches the maturity of, let's say, 3 years or 4 years, the benefit gets vested. So because there was an ambiguity that there could be other vesting conditions, so that thing has been removed. Now it has to be only the service condition or the performance condition. There can't be any other vesting condition. This might seem to be a very minor amendment, but it can have some significant consequences. It mainly clarifies the accounting for save as you earn schemes prevalent in UK. It was more relevant to UK. The requirement to save is not a vesting condition, because in the for the vesting conditions you can't estimate. That is a requirement. So if you know that there is an employee who is not going to participate in the fund in the next year, he is participating as of today, but he will not participate next year. You know that. But because if it is a vesting condition, you cannot pull out the liability from those. You have to book a full charge. But now, because the vesting conditions are only the performance conditions, so anything else becomes estimation. So you don't need to book a liability for an employee who is not going to participate in a fund in the future years, and you can estimate it today. Previously, you had to book a liability. So there would be a difference in the charge, P&L charge, because of this. Now, this was the amendment we're referring to as credit crunch amendment. In October, ISB issued an amendment to 39, which was unusual in the sense because they had to suspend their normal due process procedure in issuing amendment. Normally, an amendment is issued by circulating an exposure draft for commentary, and then based on the comments, the amendment is finalized. But this one was without any comments. Amendment allows to transfer assets from held for trading and AFS categories to loans and receivable category that would have met the definition of LNR, and the entity has intention and ability to hold that financial asset for the foreseeable future. Now, if you recall IS 39, as it stands before this amendment, once you have classified an asset under held for trading category or AFS category, you can't reclassify them. And if it is reclassified or sold, or no, that was for HTM. But for these two categories, if a loan and receivable which meets the criteria of loan and receivable, but you classify as held for trading, that is gone. You can't pull it back into a loans and receivable category. That was the original standard. So in the credit crunch, obviously there was a need to reclassify some of the assets out of held for trading category. The reason you all know, held for trading has to be mark to market. So in the credit crunch, the values had gone down. The mark to market means you must take the charge to the P&L, and the results would also go down. So they allowed this amendment as a special case. Also allows limited flexibility in reclassification of financial assets out of held for trading category in rare circumstances for assets other than those which qualify as LNR. So for LNR, you can do it in usual conditions also. If LNR was parked into held for trading, you can pull it out of that category. But if there is an HTM investment, which is parked in trading category, there have to be rare circumstances only. Then you can pull it out of that category. So that rare circumstances are not really elaborated, but the current situation falls under rare circumstances. Entities continue to be prohibited from reclassifying derivative financial instruments. Non-derivative financial, like in this amendment, only non-derivative LNR assets can be reclassified, or HTM assets in rare circumstances. What cannot be reclassified is derivatives, non-derivative liabilities, and financial instruments designated on initial recognition as at fair value through profit loss out of the fair value through P&L category. If you remember, there was a fair value model which says that if you manage your asset and a liability on a same basis as a group of assets, then you can opt for fair value option. There is a fair value option there. So if you have if you have classified some assets and liabilities under fair value option, you cannot reclassify them under this amendment. It has to be something other than that. Any reclassification into the fair value through, okay, the fair value at the date of reclassification shall become the new cost or amortized cost. Any future increase, decrease in cash receipts shall adjust the effective interest rate. IFRS 7 also amended to give extensive disclosure for such reclassified assets, intends to level the playing field between IFRS and US GAAP filer, because in the US you could still reclassify these investments, but under IS 39 you could not. So that's why this anomaly is removed. Now handout 7 and 8 are briefly to the 7 is when can you actually reclassify? It says that is the financial asset classified as held for trading? Yes. Could the financial asset be classified as LNR at the date of reclassification? Yes. Does the entity intend and have the ability to hold the asset till maturity? Yes. Then reclassification is relevant, and then you can do the reclassification. If any of this is no, then you go on the left side and you check if the situation is rare. If the situation is rare, then you can do that. If not, then no, you can't reclassify. For the other category, which is AFS, you need to see if, again, it is, could the asset be classified as LNR at the date of reclass? Yes, you see that, and then you reclassify that. So the rest is simple. Okay, there are few interpretations which we'll quickly cover. IFRIC 13, customer loyalty programs. This was issued a couple of years ago, but it is affecting people. There are loyalty programs like, as you can see here, frequent flyer miles, hotel points, credit card points, and many others. You buy one, you get one free, and you spend these many rupees at a chain store, you get vouchers. So the accounting treatment is laid down for those points is laid down in this IFRIC. What it means is, what it requires is that first of all, multi-element transaction